Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 30th of May. I'm Daniel Lam, your host for the podcast. When times are quiet, it is human nature to try to think about how things may go wrong. So, in my most recent media interviews, there were concerns about the weakness in the latest US Treasury bond option, and that could possibly be caused by the strong consumer confidence numbers. Now, combining this with the recent hawkish Fed speak, that led to concerns about, yet again, any powering down of Fed rate cut expectations and pushing out of its timing. So let's dig deeper into these concerns. So first of all, the headline index of the Conference Board's measure of consumer confidence improved to 102 from 97.5. That's upending the expectations of a continued moderation to 96. The rebound follows 3 consecutive months of decline. So this improvement was led by the expectations component, which rebounded from 68 to 74.6. Now the expectations component could benefit from the widespread narrative of a soft landing in the short term, and this also echoes the strong CEO confidence measure from the Conference Board, something we talked about in the podcast this Monday. Now, over the last 2 years, a tight labor market has supported the Conference Board's measure of consumer confidence, but that may be slowing because several leading indicators are pointing towards potential labor market downturn. The balance of respondents reporting that jobs are plentiful versus hard to get has been steadily declining since 2022. So with all these in mind, we do get some conflicting implications as to what the Fed's monetary policy may evolve over the next 3 to 6 months. And of course, don't forget, looking at this year alone, we already had a massive downscale of the rate cut expectations in 2024. So it sounds like a mindful, right? So rather than overly analyzing the implications on rate cut expectations, I believe investors had been and are increasingly zooming into the more idiosyncratic stories out there. So for example, the overall strong future guidance of the US mega cap growth stocks. Rather than really overdoing and overthinking about the Fed policies, investors want to go back to investment ideas that they're familiar with, i.e. the tried and tested ones. So it is no wonder that in such a scenario, the Nasdaq 100 has been making new highs. Now, how do we see things going forward? Well, in a Goldilocks environment, it is a good environment for the mega cap growth stocks to be grinding even higher. Even the ones that did not report such strong guidance have been met with enthusiasm as they corrected with higher than usual buying volume from investors. So we're staying overweight US equities, and in particular, sectors such as technology and communication services. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.